Good morning, friends. Today we'll make a very short video on how to analyze the market with the options prices. So today we'll take a very simple example of how to analyze market levels using the information that we get from the market itself. Okay, so we'll not make any big assumptions, just we'll take the data from the market and then let's see how to gain from it or how to benefit from it. So we have Nifty spot price at 21,314. Probably it would have been 5 or 10 minutes delay. Don't worry about the real time part, just try to understand the concept. So and this we have Nifty future, which is at around 2410. So let's increase the font size. And then there is something called Nifty S. We'll come to that in a bit. We'll come to that in a minute. Then we have 300 call price at around 141. Prices would have changed in the past 10 minutes, but don't worry. Again, I'm mentioning don't focus on the trade part. Like don't think that how will I get a setup or how will I get a strategy or how can I use this information. That will come later. But just understand a key piece of information that market keeps generating and telling you. So we have 300 call price, which traded at 141 a while ago, and then we had the put price, which traded at around 83. Then forget about the average. Let's not go there. And this is the premium or discount that the market is trading at. That means the futures are commanding a premium. That means market players or people who want to hedge or who want to speculate, whatever it is, don't get into the nitty-gritty of it. Nifty future is being traded at a premium. If the underlying is at 314, people are ready to pay $100 more to get a future, to buy the future for either for hedging or speculating. Forget about it. Similarly, call prices are trading at 141 and 83. Now what happens is this Nifty future, this expires on month end, right? On month end. However, we have call prices which are going to expire on the every weekly, which is like for now this is going to be like 21st or 22nd or whatever it is. So both these weekly prices are going to expire on 21st next week. So the time frame between these two is different. Okay, so this is going to have a life until month end, and these two are going to have a life until only next week. After that, these two contracts will not exist. Everyone knows this. I mean, there is no rocket science behind this, and again, I'm just setting the tone of how to arrive at a particular level and then use it for your trading. That is the motto behind this video. Now what happens is there is something called a synthetic future. What I mean by a synthetic future? So as the name suggests, the synthetic future is not traded directly. That means you will not get that future ready-made like this monthly future, like this December future. So you have to arrive at based on the information that the market is generating. This is generated by the market. This is generated by the market. We'll write M. This is generated by the market. And then this is generated by the market. And this is generated by the market. Now what happens is we calculate this synthetic future very simply. You take the strike price. Okay. Don't take the spot price. You can do that, but better not to do. That is not a norm. So you should take the strike price, which is around 2300, 21300, because we are considering those options, and then you add the call and subtract the put. Okay, so how do you remember? You just add the call because it is long. It gives exposure for the long side, so you just add it, and then you subtract the put. Now whatever is the difference, you just add it to the strike price. Now what did we arrive at? We arrived at a figure 21318. Now the beauty of it is, don't think like it is some kind of what I can say, a system or a setup or a trade. How I can use this video as a trade setup or anything. Forget about it. What the effort of this video is to tell you that this particular level 21358 has some significance for today, because I calculated it today. Naturally, it has significance today. Now what happens is, these prices keep changing. For example, I could have taken 21200 call or 21100 call, depending on the strike price or depending on the trading level of the market. For example, there was a gap down and today the market was trading at around 2925. Then I would consider 2900 call or 21000 call, right? So you need to use just judgment here, like what is the strike price you are taking, and then you have to take the nearby options. Okay, so we have taken 21300 here. And why we did not take 21400? Because the market has not yet crossed. Don't think future has crossed. The main rule is you need to stick with the underlying. Don't get into or don't get dragged by what the future and options are doing. Okay, so I'm not saying they are important. The future levels and option levels are equally important. But in this video, we are trying to arrive at a particular level, like 21358 is the level which is very important, which was very important for the market today. Now I took the prices like say around 10 or by now it would have been 15-20 minutes ago, around 5-minute bars. So now what we will do, we will see whether this level that we have arrived at holds any importance or not. Okay, let's go to the chart. I'll bring the chart here, and then let's see whether that particular level had any significance. Okay, so here is the chart of Nifty 50, and we arrived at a level of 21358. So I'm going to change the level to 358, and now you see how the market has respected this particular level. That is the motto of this kind of video. So you see that today the market has respected that level. That means options players are protecting that level hugely. Don't get into the mechanics of it, like why it happens, what is the motto behind it or anything, but it certainly gives, this particular level gives you an understanding of a key level in the market. So this is how we should arrive at key intelligence that comes from the market. Hope this video helps you. So probably you could try tomorrow, or probably day after tomorrow, or that is on Monday, you arrive at a particular level and see how the market behaves there. So this particular learning will help you in the long run. So every day keep a track of what the synthetic future is doing, because when that level of synthetic future comes, what happens is the market behavior certainly has some importance. You cannot kind of ignore that information and leave it wasted. Have a great day, guys. Bye bye.